Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis. Good to have you back again as we enter into Taking Stock, episode 50.
Man. Great to be here, and I can't believe you kept me around for 50 episodes. That's amazing.
So, I have to ask you, how are you?
You know what, Chuck? I'm fantastic. Thanks for asking.
I know, fantastic.
Especially after the market action for the last couple of weeks.
Which is, we're going to talk about that, I guess.
Yeah, let's talk a little bit about that.
And like a little side note that people don't know it, so I handed off a book to you today because you and I both admitted that, we're going to have to, I've got to have Austin Jarvis or Caitlin Geffrick on again soon, which we're going to do. But I say that because I handed off a book to you and I got a copy of it because they're the ones that should talk about cryptocurrency, not Chuck and not Art.
You would definitely get a much more intelligent conversation from them, right? I'm working hard to try and figure it out. But I will openly admit I'm kind of that old man in the equation. So.
Well, you and I will be able to compare some notes down the road. Obviously got to put that on your reading list now. But Rick Edelman's "The Truth About Crypto," which is described as a practical, easy to understand guide to Bitcoin, blockchain, NFTs, and other digital assets. Well, we'll leave that to Austin and Caitlin for now. But I'm going to read it so at least when I'm talking to them, maybe I'll have a clue. I don't know. We'll see.
Might be some buzzwords in there.
I got some. So Chuck has some homework before he hosts that Bitcoin cryptocurrency show with Austin and maybe maybe two different shows or maybe one with both of them there. We don't know, but we'll figure it out. But for today, like you said, fantastic.
Yeah. I mean, so 5 weeks ago, roughly, if I remember correctly, we did, you call and say, hey, you want to do a special report? And I was like, yeah, that sounds like a great idea, especially based on the morning I'm having. But, we, at least I hope, we tried to pound home the fact that the market was in an area where it didn't belong, even if bad things were coming down the pipe. We had already, at that point, that morning, we had taken 20% out of from the top of the market in February.
Well, your two-word thing, fear and greed. Yeah. The driver was fear on that day, at that point, that week, actually.
Just unimpeded fear. I guess if that's the right word for it.
Well, and we tried to put a little roadblock up, stop the fear train from crossing down the tracks or rolling down the tracks, and thankfully, as you recall, that was a Friday.
Yeah.
And so the weekend had its settling effect, and then we went kind of on a roll of upward trend, and the market settling on rising.
Yeah. We basically have been on a 5-week run up in the market. When we talked 2 weeks ago, episode 49, we were hoping we were approaching the 5,600 level on the S&P 500, and we were talking about that being maybe an area of resistance for the market to go up and then. So it did. It got up in there and got just in the lower 5,600s and kind of bounced around a little bit, but it's kind of stayed in that area. There was nothing major one way or the other. Well, I sit here today with you. The S&P 500 is at, funny thing, 5,888. So not only did we just basically blow through 5,600, even from a technical standpoint in the markets, we have blown past all the moving averages. We're back up here. And as of this morning, we have gotten back all of our losses since the beginning of 2025. So we're actually in the green for 2025. Now, we're still about 4% away from where we hit the top in February. Okay, but
at the start of 2025, January 1, so to speak.
Yes,
Yeah, because I was going to question that because it climbed into what, almost 6,200.
Almost 6,200, yeah,
and dropped from there.
Yeah,
but you go to January 1 and it was in that 58 neighborhood or something like that.
Yeah.
So, well,
so if I'm going to, I want to use this opportunity, and I'm pounding one hand into the other hand. Like, there's a reason you don't panic and you don't get out. Now, again, I will openly acknowledge that there are times you need to readjust and maybe get more conservative. Okay, dot-com bubble, fantastic example. The Great Recession, 2008, 2009, great example. Okay, those are great examples that were economically driven downturns in the market. Okay,
right.
So you do make adjustments to try, because we lost 55% during the Great Recession in 15 months. So guess what? I don't want to lose 55% of my clients' money.
I don't want to lose 5%.
Well, right.
I'm with you.
Right.
I understand what you're saying.
But so now we have had people, and the day we did that special report, I guarantee you that was a day, that morning was a day of capitulation, where I always kind of like to say people are throwing the baby out with the bathwater. They're like, I've had enough. The world's coming to an end. I don't want to lose all my money, which is always an interesting comment to me. You're not going to lose all, but unless something really bad happens. But, since that day, we're up like 21, 22%. And so we're up 21, 22% in 5 weeks. All right. Not only if you got out, have you missed a 20-something% move either up or back up to where you should have been in the first place, but you also maybe missed out on the vast chunk of positive returns we might have in 2025. And I still feel we can still push higher. There's a lot of positive things happening out there. And I still think, we were talking about, I think, 7,000 on the S&P. At this moment in time, I most certainly feel that that's not out of the realm of possibilities.
Right.
Okay.
Well, I was going to say, it's 2 steps and open a drawer.
Right.
Here in Studio A, 2 steps from where I am right now as we record this, and open that file drawer. I could pull out that, that forecast.
Mm-hmm.
So the bottom line is right now, the market is doing kind of what you expected. Mm-hmm. I really love that, when you said 2 words, opportunity.
Yep.
And then the capitulation. Well, I don't like that word, and the fact that you had to use it to describe what was happening. But that capitulation, that's ugly.
Yeah.
But again, one of the things you said on that Friday, hey folks, this is an opportunity to buy, not a time to get out. The last thing you want to do is sell off when it's down, right? You want to sell high. Those are those simple things, because Chuck doesn't know anything. So Chuck knows, buy low, sell high. The market just dropped, whatever, couple percent at that time, and everybody's freaking out, and fear's driving the sell off, and it's like, sell now? Sell low? No! And so, the message that day was this is an opportunity, if anything. Otherwise, and you said it wasn't like an economic downturn
Not at all.
that required, readjusting maybe what your goals are or how you're trying to achieve them. Not adjusting your goals, but adjusting how you're going about trying to achieve them. A key word that came up for me in the past 2 weeks since we did the last, episode 49, Art, was... I was, unfortunately for the listeners, they've heard this before, and you hit me in the back of the head. But Art Jarvis is not my personal advisor on finances. We were doing this before I even knew you.
Yeah, we're all not perfect.
Right. Like I said, he hits me in the back of the head when you listeners aren't hearing or listening or looking or anything. But there's a sore spot. We just stop it. If you've ever watched NCIS, it's that slap to the back of the head from Gibbs, and except I get it from Art. But anyway, the bottom line is in these past 2 weeks we had our meeting, and I was reminded of rebalancing.
Yeah.
Rebalancing. And what was, of course, nice is talking with our guy, whose name is Sean. But anyway, we were talking with Sean, and I got questions because I'm learning things, from doing the show and things that you share. And so, I like to ask him the questions and make sure that we're, being well represented, well advised, and our money's being cared for before I have to move it to Jarvis. But anyway, the rebalancing question. And he went through very thoroughly with us and showed us, how ours rebalances, like naturally.
Oh, okay.
So, because, I make contributions to our retirement account monthly, which, by the way, listeners, one of the things, Art, we've talked about it many times, especially for those, 18 to 25-year-olds, let's say.
Yeah.
You should be making contributions to you should have something set up and making contributions to a retirement account right now, and you will be so happy when you're like 50,
It's literally a no-brainer.
Right?
I mean, it really is. I mean, unless something tragic happens in the world, but, but if you're constantly putting money in, don't forget, so let's say we dropped 20% off the high this year. Well, those people who are putting money in every paycheck or once a month or whatever, guess what? They were buying into a market that was 20% down. So, 5 weeks ago they put money into a market that was at 4,800, and now the market's at 5,800.
Right.
And that's just four or 5 weeks.
Right. They were buying, as you said then. Now's the time. There's some bargains out there.
Yeah.
And I get, and though it's been climbing over these past 5 weeks, there's still some bargain.
Oh.
If your projection is correct, you expect to see it still grow during the remainder of 2025. I mean, it is only May.
Right.
513, by the way, for those of us in the Cincinnati area code, today is May the 13th as we record this. So 513, baby.
That's right.
Good day to buy.
513 rules.
Gotta have some fun.
The only reason I saw that this morning.
Yeah.
It's like somebody posted something, 513 rules. I'm like, okay, I'll agree with that. But and the funny, a couple things. At the very end of episode 49, 2 weeks ago, you asked me a question. And the answer was, if you're going to talk to your investment advisor, what are the opportunities that currently exist in the market, and what are we doing to take advantage of them, right? Well, again, 2 weeks ago, we were talking in the 5,500s, banging up against 5,600, getting close to 5,600. We're almost 300 points past that, or 250 points past that now. I mean, it's just, and here's the beautiful thing, and once again, we talked a little bit about last week, 2024 was very much a technology-weighted performing year. Okay, the vast majority of returns in 2024 came from the technology sector and really came from a handful or two of stocks that really drove that index up. Okay, what has happened is during 2025, when the market dropped, let's say it got down 20% from the high, not only those sectors that I will call neglected sectors or neglected asset classes from 2024 did not go down as much. Okay, so it was really the technology sector was really getting beat up. All the darlings of Wall Street from 2024 were getting beat up pretty hard, right? But the other sectors did not go. They went down, but they didn't go down as much. Well, guess what? Now here we are. We've come up 20%. Well, guess who's leading the way? I mean, technology stocks, especially in the last week, have really started to make a nice comeback. But guess what? All those neglected sectors, not only did they not go down as much, they're also leading the way on the way back up. So
they're leading the charge up the hill.
Yeah. So you and at least for 2025 anyway, you have portfolios that, one, are outperforming the market, and two, are doing it with less volatility. Now, we're only talking about 4.5 months, but that's exactly what you want to happen. That's exactly what you want to happen. So, I sit here in front of you. I'm pretty darn pleased with the way things have been going here lately. It's a little bit of you you get on the phone with clients and things, and you say, it's going to be okay. We're not anywhere near where we belong. We're trading on fear. This is not an economic-driven downturn in the market. And you say all those things, but I'm human, so I get off the phone and you kind of in the back of your head go, boy, I sure hope I'm right. I can look at. I'm not always right.
Walk away from that client, hang up the phone from that client, and whisper in your own ear, I hope I'm right.
It's. But it's
well, hopefully, and you hope you're right for a lot of reasons. But one of those is because you care about what you're doing to take care of your clients.
100%. I don't particularly worry about myself. I know if I made a mistake, it's because I did it to myself, right?
Amen.
If someone else is suffering because I did it to them, I take that very personally. So you're right. So. Yeah,
there may not be a Hippocratic oath that says do no harm, but that's our own personal. You don't want to harm somebody else. What you're doing.
The new buzzword, which for the last few years has been fiduciary.
Yeah, well, yeah.
So now you've got people going around, I'm a fiduciary. And I'm like, well, I hope so. It's like you better be a fiduciary. If you're not a fiduciary, your clients should probably run for the hills. I have been a quotation fiduciary for 38, 39 years. Guess what? Every single decision I make is for the benefit of the client. I am by purchasing things in their portfolio that not only do I believe is going to do well for them, but it's also appropriate for them from a risk standpoint, from a liquidity standpoint, from all those kind of things. It's like you got to take care of the people. It just I get to put, hey, so and so sent me here. I got a couple questions, and one of them is, are you a fiduciary? I'm like, yeah. It's like I better be, right? But now it's a thing, right?
Right. No, we certainly have seen it advertised, heard it advertised. Seen it on television, heard it on the radio. Fiduciary, 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 or you're not a fiduciary. I like the way you just put that. If your guy is not a fiduciary, you should run for the.
If you ask that,
or just run to Jarvis Global Investments because they are a fiduciary and have been all along. But the bottom line is, so fiduciary again for the listeners, because we're throwing a word out there the last couple of minutes and it's been out there. They probably know it, but the bottom line is fiduciary means that by law. And whatever your licensing and everything else is, you have to put the best interest of the clients first. It's not about fees or whatever. And there's some way. I know you for example, Jarvis Global just went through is it annual audit, so to speak?
It's normally once every 2 years from the state of Ohio.
Okay, so but that's a check and balance thing that says you are doing the right things. Yeah. Whatever, all of those things. Caitlin's not here.
Funny that you say that because she's actually at the office working on our response to the letter we received from her.
Right. Well, there you go. But that's what's that title again that she carries? It's
Chief Compliance Officer. Is that the one?
The point being the keyword. We've got a lot of keywords so far in the first half. We're a little bit past halfway through today's episode, and we've had some words. Now we just threw out compliance. So you have to comply with that to continue to be a fiduciary and to stay in business. You got to comply with those rules that apply to being a fiduciary in the best interest of your clients. We've thrown a few terms out there today.
Yeah.
I find it interesting that we've just by a few minutes we've passed the halfway mark, and it's 2025, and 2025 Taking Stock episodes have been filled with the word that starts with T, tariff. Yeah. However, we haven't said it until I just said it. Right. We haven't said it in the first half of today's show. But I wanted to bring it up because it's a key thing. Tariffs, guess what? We've been talking about it, and I'm mad. I'm mad because we even now, after there's been some sort of a, good news from a tariff agreement in writing. We'll see. But
definitely more positive.
Yeah, more positive tariff news. And so the naysayers, who are the other media, there was a report that I heard this morning that said, the market's been on a rise, closed such and such, with that tariff agreement drove it. However, and boom, they barely touched it and said, however, the CPI is coming out today. So this is the reason I just brought up tariff, because we had good tariff news.
Yeah.
But the media jumped on, the CPI is coming out today, it's expected to be bad, it's expected to show that we're, leaning more toward, inflation numbers being higher.
A little hotter.
And so anyway, my question for you, Art, is did we already get that CPI report?
Got it first thing this morning.
I've been waiting for you to tell me.
Not only was it good, it was better than expected. So they were looking for 2.5% year-over-year consumer price index, or consumer inflation. It actually came in at 2.3. So now some things affect that. Obviously, I paid $2 and $2.82 per gallon yesterday. So we're below $3,000 or $3,000. Yeah, we're definitely below.
I'm not paying $3,000 per gallon.
Yeah, I might even look at the pump then.
I'll be in even better physical shape, because it's going to be all walking, running, and riding.
We're buying stock in bicycles, electric bicycles, of course. But so there. It's been, honestly, it has been a stream of positive news, with one exception, and I'll get to that. But it's been a stream of positive or more positive news.
Click them off. What do you got?
People are coming to the table to negotiate the tariffs.
Right.
Okay. So and we signed a deal with the United Kingdom. So that's a done. That, at least part of it's a done deal.
That almost you almost got a message from me. Hey, should we maybe do a special report? But we didn't. Anyway, go ahead.
Here we are.
Yeah,
China's come to the table. As soon as they came to the table, we cut the tariffs. Both sides cut the tariffs. So there you go. The consumer price index number the inflation numbers are still good. The employment numbers are still good. Guess what? The consumer although I can't wait to see the consumer confidence and consumer sentiment numbers a month or so from now. Okay. But guess what? They're not happy, but guess what? They're still spending money. Okay, so they're not happy, they're not confident, but I still want stuff.
What do you say? What do you say to the statement or question? Depends on how you look at it. I'm going to pose it as a question. What about the slowing economy?
Yeah, right. There's the other topic right there.
Okay.
So gross domestic product came out last week, right? And it showed that the economy contracted in the first quarter by 0.3%. Okay, so that's the first number on the first quarter. So a definition.
0.3%.
1%. So it's a slight slowdown, a very, very slight slowdown. We didn't grow, but we also didn't drop 4 or 5% either. But it's again, a recession. The definition of a recession, which is the other buzzword, is that 2 quarters in a row of a declining economy. Okay, so number one, we got the first number for the first quarter. Well, guess what? There's going to be 2 revisions. So we're going to figure out what that number is supposedly over the next 6 months. So 0.3 can get better, 0.3 can get a little worse, okay? But if we're even to be considered a recession, the second quarter, which we're in right now, also has to be less than 0, okay? So, we're not even in that scenario, but even more interesting. So I can't remember what day it was. It might have been Wednesday last week. They reported a 0.3% decrease in the economy for the first quarter. Well, guess what? The market went up.
Right.
Okay? Because here's the thing. There's buy the rumor, sell the news, or in some cases, sell the rumor and buy the news, right? In this case, it was, Sell, you know, we're worried about a recession. We're worried about a recession.
This was sell the news.
Yeah, we sold the news and we bought. Well, no, I'm sorry, we sold the rumor. Yeah, and then we bought the news on it. And so guess what? The market goes up, whatever it was, 0.75% or something like that. Because guess what? We took a bit of an uncertainty out of the equation, and that's what it's all about. It's uncertainty. The market does not like uncertainty. That I don't care what you look at. If you look at oil prices, you look at inflation, you look at tariffs, you look at whatever you want to look at. It's the unknown factor that causes all the problems. And you know, you go back into history. I mean, you look at things that we just beat to death. Like there's certain things like you know. I would hear the word cryptocurrency 24 times a day for a while there, right? I would hear oil. I would hear Brexit. I would hear tariffs, and I hear I bonds. You know, when inflation went up to 9 or 10%, all of a sudden everybody was talking about I bonds because I bonds weren't worth anything. But then all of a sudden inflation went up to 9 or 10%. Well, now you're getting 9 or 10% on hyper-conservative I bonds, right? So yeah, so everybody was, it's we get our teeth into something and we just stay with it. But the problem with that is
dog with a bone.
It's a dog with a bone. And take a great example is Y2K. We beat Y2K to death, okay? And it came out. Nothing bad happened because we spent 2-3 years talking about it. All these companies had nothing but time. If they needed to upgrade their computers, they got them upgraded. If someone didn't upgrade their computer, it was probably mom and pop off. It didn't matter anyway. But it's always the thing that you don't. It's always the thing that you don't see coming that you got to worry about. And I'll give another perfect example is the pandemic in 2020. It's like we are rocking and rolling. We're doing great. The economy's chugging along. Inflation is great. Employment's great. Everything's great. And then all of a sudden the world got turned off. Right? I mean, literally, basically almost in a day. We lost 35-45% in the market in a couple weeks.
Right.
Nobody saw that coming. Well, 99.9% of people didn't see it coming, right? So it's that kind of stuff that you got to worry about. But it's all about uncertainty. And what we have been doing over the last 5 weeks is slowly plucking away at the uncertainty.
Yeah.
Okay.
And what we talk about here on Taking Stock, what we have talked about for 49 episodes before this, and we've actually done a couple of those special reports. It's certainty, because I'm reminded as you bring up the word uncertainty, which we've talked about because it drives some things, or it's an explanation for some things that have happened while we've done it. But we talk about certainty because one thing that's certain is you are looking at the numbers. Right. And those numbers are, it's like watching football on Sunday or even on Saturday, college football. But throughout the football season, when you flip on your football game on Saturday, whether it's college or Sunday if it's the NFL, and it's filled with pregame show. No certainty.
Right.
A whole lot of speculation.
Yeah, right.
And you know what? People will even get, and it's sports, but people will even get wound up about they're picking the Cowboys instead of the Bengals, or whatever. And so everybody's been out. The game hasn't been played yet.
Right. Yeah.
But guess what? On Monday morning, we have a result. Not even before Monday morning, but it's being reported. The result is being reported. So certainty is what you talk about here on Taking Stock. Our listeners are hearing the things that you're looking at and analyzing and helping your clients, and even sharing the information out there to other, to listeners who can maybe talk to their advisors about making sure, are we doing these same things? But it's looking at the numbers, analyzing the numbers, and taking action based on reality, not because, Jimmy Jones picked the Cowboys on, a half hour before the game started.
Yeah.
The game is going on.
But people pick games because of that. People pick stocks because of that.
Right.
Some guy, some talking head, got on TV and said blah, 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 and, well, I heard this on TV, so I'm going to do this. Well, I got a theory that once you hear it on TV, it's already a done deal. It's already happened. You already missed it. Money Magazine. Money Magazine says this and this. I'm like, well, if it's in Money Magazine, it's over with. You already missed it, right? And Mom, she'll say, oh, when back in like 1999 or stuff like that. I heard about this company, Qualcomm or something. Blah, blah, blah. And my mom starts talking about Qualcomm. Guess what? The party's over. It's time to start. Not only is it time to sell Qualcomm, it might be time to short Qualcomm. And it's what happened. You had all these technology stocks. People were making 60, 70% per year in their portfolios because they're so heavily weighted in technology. And they got in, but how many people got in kind of toward the end? And then 2000 hit. The NASDAQ 100 was at, by the time you got to the year 2000, we had pushed that up to just the land of ridiculousness and too high. and the NASDAQ was at 5,000. Okay. By the end of 2000 or so, it had lost 80%, and we're down to 1,000. Okay.
Right.
It took 15 years for the NASDAQ to go from 1,000 to 5,000 again. So it took until 2015, 2016 before those stocks got back, or that index got back to where it was back in 2000. So that's no bueno. Okay, that is no good.
No bueno.
So that's
no bene.
You hang on. You stick with the plan when there's a good reason to stick with the plan. Okay, or there's not a good reason not to stick to the plan. I guess that's a better way to say it. But I will acknowledge that there, especially in my 39 years or whatever it is, coming up on 39. Ouch, that hurts. There are time periods where you look and go, okay, this what's going on right now is not a good thing. Okay, and that's once again the .com bubble. We took that. I always look at things like from what's the average, what's the standard deviations above and below, what's average.
Right.
Okay, we were so far past the third standard deviation on the technology stocks in 1999. It was ridiculous. Okay, it was screaming. And we did. We kept getting 1999. We kept getting more conservative, and guess what? They kept going up, and they're making us look bad, right?
Right.
Well, guess what? We looked really good come 2000,
when
right?
the bubble burst.
And that's why you run a diversified portfolio.
Perfect. That's probably a good place because we're out of time.
That was fast.
I was going to say one final thought. I think that was it. Mm-hmm. So, and it goes back to many times we've said to stick to the plan. Mm-hmm. But one of the things that just came from your final thoughts and that final summary, this is not one of those times. Right. This is not a no bueno.
Yeah.
These are, despite some volatility, these are good times. Yes?
I feel that way, yes. Now, but I also believe that there will be things coming down the pike that are going to stir our pot and cause volatility, right?
Sure.
Can I tell you specifically what those are right now? No. But I can guarantee you that there's going to be stuff that doesn't make us happy in the next few years, right?
And we're going to talk about those things on Taking Stock. And you can listen to this one. You're listening now if you heard me just say that. But you can look forward to Taking Stock episode 51 in 2 weeks from now. And Art Jarvis, thank you so much for joining us once again today.
Yeah, thank you, Chuck. Always appreciate it.
My pleasure, my friend.
Take care.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.